Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 8th of January. I'm Daniel Lam, your host for the podcast. Now, last Thursday, we spoke about a US recession being one of the biggest risks to our relatively constructive view on risky assets in 2024. The tight labor market has been a source of resilience in the US economy, and thus a gradual weakening in the non-farm payroll numbers could be the most ideal outcome for the markets. However, last Friday's non-farm payroll numbers surprised on the upside. It jumped from 173,000 to 216,000 in December, and that beat expectations of 175,000. Wage growth also surprised to the upside. But digging deeper, the industry-level data reveals that the bulk of the December increase is concentrated in three sectors, i.e. education and health services, leisure and hospitality, and government, while several industries are experiencing a decline in employment, and notably that in transportation and warehousing. And the results of the household survey showed that the number of employed fell by 683,000 from November. And similarly, the employment index from the ISM Services PMI collapsed from 50.7 to 43.3, is the lowest level since July 2020. So overall, one would conclude that the data on Friday was hawkish at the headlines, with some dovish details mixed if we dig deeper. This may make investors somewhat nervous about overly dovish trades at this moment in time. So if you look at the market action, the US 10-year government bond yield continued its rebound to above 4% level, and the rate-sensitive names continue to be under some volatility. However, volatility does give rise to opportunities, and we do believe so this time also. We see 4.3% as a heavy resistance for the US 10-year government bond yields, and Nasdaq 100 having good support around the 15,000 to 15,500 area. The weaker labor market demand will first reduce job openings, hirings and quits, and then ultimately feeding through to higher unemployment, at which time the Fed will need to be cutting rates in order to shore up the economy. And that is favorable for these so-called long-duration trades. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.